Welcome to this explainer. Today, we're cracking open the files on one of the absolute most dramatic corporate autopsies in modern startup history. We're talking about a company that promised to completely revolutionize the future of work, captivated the globe's wealthiest investors, and then, well, it ended up becoming a massive cautionary tale that's now being taught in business schools all over the world. Okay, let's dive into this. $47 billion. Just take a second to let that astronomical valuation really sink in. At its peak, this startup was considered more valuable than some of the world's oldest, most profitable public corporations. It was the golden child of the startup ecosystem, and every major venture capitalist out there desperately wanted a piece of the action. But behind all those glossy presentations and the billion-dollar headlines, there was a massive, fatal structural problem that was just quietly growing in the background. And that brings us to the central mystery of our explainer today. How did a company that, let's be real, simply rented out office space convince the smartest investors on the planet that it was the future? The answer isn't about some revolutionary software or a groundbreaking proprietary algorithm. It's actually about vision, charisma, and arguably one of the most effective storytelling tropes in modern business history. Section 1. Selling a tech dream, the illusion of innovation. To really understand this illusion, we have to rewind to 2010. Founders Adam Neumann and Miguel McAlvey took this small, eco-friendly co-working concept called Green Desk, and they just blew it up into a massive global movement. Because they weren't just renting out desks, they were selling community. Walk into an early WeWork, and you were hit with bright open spaces, networking events, kombucha on top. You weren't just paying for a spot to put your laptop, you were paying to belong to a lifestyle. They essentially pulled off a brilliant Trojan horse strategy for venture capital. Think about it. If you're a standard real estate landlord, you get valued on your physical assets and your slow, predictable profits. But if you can convince the market that you're a quote-unquote tech platform and a global community with infinite scaling potential, well, suddenly the sky's the limit. This narrative absolutely captivated investors, especially SoftBank's Masayoshi Son, and it instantly unlocked billions in funding that a traditional real estate company could literally never dream of getting. And this brings us right to the ultimate storytelling trap, vision. In WeWork's case, vision was practically weaponized. It was used to sell the glorious future potential of the company while totally masking its messy present financial reality. Neumann had this undeniable charisma, and his grand speeches about, elevating the world's consciousness, it created a massive reality distortion field. The market got so blinded by this inspiring ecosystem of innovators that they completely ignored the actual day-to-day business operations that were ticking away in the background. Section 2. The fatal business model, the reality of the math. So the crucial point here is that eventually we have to strip away the free coffee, the beautiful glass meeting rooms, and the stylish lounges, because no matter how beautiful a story sounds, at the end of the day, the math has to make sense. Here is the fundamental, fatal flaw of WeWork's entire operation, and it's basically a math equation from hell. Look at the liability side. WeWork was signing these massive 10 to 20-year leases on prime commercial real estate and just pouring hundreds of millions of dollars into luxury renovations. But on the revenue side, they were relying on startups and freelancers who were paying on highly volatile, short-term, sometimes literally month-to-month agreements. They were carrying billions in fixed, long-term real estate obligations, but surviving entirely on totally unpredictable, short-term rental income. This dangerous imbalance created a hyper-growth cash burn that was just off the charts. It became this vicious cycle. To justify that soaring $47 billion valuation, WeWork felt they had to expand globally at all costs. They were leasing entire buildings years in advance, outfitting them with premium architectural design. But here's the catch. The faster they expanded, the faster they burned cash. For every single dollar they earned, they were spending significantly more. The entire machine was surviving for one reason and one reason only. Investors just kept injecting fresh capital to keep the lights on and the dream alive. Section 3. The spectacular collapse, the S1 revelation. Now, in the private market, if you want to get your money out, eventually you have to go public. And that's where things get real. In 2019, WeWork filed the paperwork for their IPO. But when that S1 document finally dropped, the private illusion crashed headfirst into public market scrutiny. Wall Street dug into the numbers, and they were absolutely shocked. The actual business model was vastly weaker than the billion-dollar vision everyone had been sold for years. The immediate shift in public perception was just utterly devastating. And this brilliantly illustrates exactly what sent investors running for the exits. The filing didn't just reveal massive, completely unsustainable financial losses, it exposed a shocking lack of corporate governance. I mean, Adam Neumann had structured these super voting shares that gave him total, unquestioned control over the company. Even worse, it revealed some severe conflicts of interest. Neumann personally owned properties that he was leasing back to his own company. At one point, WeWork even paid him millions of dollars for the rights to the trademarked word we. I mean, you can't make this stuff up. Once public investors read this, confidence just evaporated overnight. What followed was a rapid, brutal unraveling. By September 2019, the board actually forced Neumann to step down, though incredibly controversially, he walked away with a massive exit package worth hundreds of millions of dollars, all while ordinary employees watched their stock options completely tank. The company was already on life support at that point. Then, 2020 hit. The global pandemic emptied out offices everywhere overnight, which just accelerated the destruction of their incredibly fragile business model. Despite some desperate rescue attempts by SoftBank, reality finally caught up. In 2023, the $47 billion unicorn officially filed for Chapter 11 bankruptcy. Section 4. Lessons from the Fall. Demystifying the disaster. Because look, WeWork's collapse isn't just about one arrogant company feeling. It is a vital post-mortem for your own understanding of business and investing. Let's move to these universal steps and see how this builds a framework for evaluating literally any business. Step 1. You have to differentiate growth from actual success. Expanding rapidly while losing billions of dollars is not a sustainable victory. It's a ticking time bomb. Step 2. Demand transparent corporate governance. Strong, resilient businesses are built on checks and balances and independent boards, not just charismatic founders operating with zero oversight. And step 3. Respect the financial fundamentals. Cash flow matters. No amount of brilliant branding or bold, world-changing vision can ever replace a fundamentally sustainable business model. Ultimately, this drives home the absolute most important takeaway from this whole saga, the stark difference between valuation and value. Valuation is so often just hype, right? It's an optimistic estimate of what a really good story could be worth when money is cheap and excitement is high. But real value? That's a business that can actually survive changing economic conditions, control its costs, and generate sustainable profits over time. Valuation might get you on magazine covers, but value is what guarantees your survival. Which leaves us with a final provocative question. Whether you're a founder building a business, an investor evaluating a hot new tech stock, or honestly just someone trying to make sense of today's crazy economy, are you investing in the reality, or are you just falling in love with the story? Because as WeWork proved to the entire world, eventually reality always catches up. Thank you so much for joining me for this explainer. I really hope this gave you a powerful new perspective on one of the wildest rides in corporate history. Stay curious, always focus on the fundamentals, and I'll catch you next time.
If you like this video, like, share, and subscribe to Wealth Decoded for more of our business, finance, and tech explainers. Turn on the bell to get notified when a new video is uploaded. Thank you for watching, and we will see you all in the next one.